Good evening, everyone. I'm Dr. Mark Brannon. I'm a member of the board of the Princeton Adult School, and I welcome you to tonight's lecture, the last in the series on modern marvels engineering the future. So it's now my distinct pleasure to introduce to you tonight's speaker, Ronnie Surkar. Professor Surkar is a professor of operations research and financial engineering, and ORF, I think, is the acronym and he's now the acting chair as well of the Department of Operations Research and Financial Engineering. And as you know, this has been especially pertinent for this course because we have been guests of this sign that's right in front of me here, the School of Engineering and Applied Science. Professor Surkar was awarded a Howard B. Wentz Junior Faculty Award, which he used to facilitate his research projects on engineering problems arising from finance and economics. Some of these problems include better understanding of the market volatility and its effect on complex portfolios, and management of risks arising from derivative securities. Maybe some of you might not have known what those were 3 years ago, but I think it's very appropriate from what's happened in the markets in the last 2 years. He joined the School of Engineering and Applied Sciences in the fall of 2000 as an assistant professor in the Department of Operations Research and Financial Engineering. Previously, he was an assistant professor of math at the University of Michigan. Professor Surkar received his PhD in scientific computing and computational mathematics from Stanford in 1997 and holds a master's degree with distinction in mathematical modeling and numerical analysis from Oxford University. He earned his bachelor's degree in mathematics from Oxford University in 1992. The topic is very simple today. It's called quantitative finance. I have no idea exactly what that means, but let's welcome Professor Surkar. We'll all learn.
Okay, so thank you, Mark, for that kind introduction and the invitation to speak here this evening.
Let me turn it up a bit. See how that is.
Does that sound better? Loud enough?
Can you hear him? Okay.
Okay, great. So as Mark had mentioned, I teach in the Operations Research and Financial Engineering department here. That's the newish glass building. Maybe it's too loud. Is it too loud? Is that better? No. Is that muted? Maybe that's muted right now. Oh, that's one. Right, okay. Is that better? No. My name is Ronnie Surkar. No. I can hear it.
Yeah, that's
Can you, is it
Just try and project a little bit.
I see. Okay. All right. So I'll try and speak a bit louder then, if that's. No, I don't have a cell phone. Is it whistling? Is that? It's a whistle. Turn the volume down. Okay, let's try that. Maybe that's better, and if I speak louder, is that reason? That's better? That's not it?
I don't think it is either.
Just coming in the building?
I don't think there's any either.
Higher? Should I put this higher? Or okay. Up here? Is that too high? How's that? That's better. Okay, all right. So After the false start, let me start again. So I teach in the ORFI department, Operations Research and Financial Engineering, which is in this new glass building that you may see on the way out across here, Sherrod Hall, that opened about a year and a half ago. And my colleagues and I were primarily, or at least half of us, are involved in sort of quantitative analysis of finance. And let me say up front, when you see a title like financial engineering, let me just say it's not my fault, and I will try my best to explain what we do. And if you want proof that it wasn't my fault, I did not make obscene amounts of money over the previous 10 years. That's certainly true. I was teaching. So let me say a little bit about the subject of quantitative finance. It's a much better title than financial engineering. I've never liked the connotations of financial engineering, so I have always referred to it as quantitative finance, or financial mathematics is another name that we use. So what we do is mathematical models that can be used for finance and economics problems. And what kind of mathematics is that? That's the mathematics of uncertainty, which means probability theory. We write down models, some of which I will talk about, which try and address, either through probability or statistics, what we've seen in financial markets in the past, particularly, let's say, with respect to volatility, and how we can have a reasonable statistical description of that. But most important, we don't know how to make specific predictions. So everything is about randomness and probabilities. There are very few sure statements. Everything is about quantifying the risk. We know there's risk, and we would like to, as best as we can, try and put a number or a set of numbers to that. So that's up front a limit to what we can do. We're not naive enough to think that we can tell you where some financial variable is going to be on some particular date in the future. And of course, nobody can with any, at least nobody honestly can tell you that for certainty. So that's not what we're about. So if you like, we were more pedestrian than that kind of thing. So what we're interested in terms of science is stochastic models. Stochastic is a word that's essentially interchangeable with random. And we're trying to quantify uncertainty in prices and some other economic variables for different kinds of problems. This field, which, depending when you take its birth to be, it could be 35 years old, it could be 20 years old, depending on how you want to date the sort of explosion in this kind of work. It departs from classical economics. So it models things at a phenomenological level. So there are stock prices. They move in some seemingly random way. They have some structure, but essentially they look chaotic. They look like results of tossing coins or complex random objects. And we take that in these kind of models as a given. So we don't try and understand why the stock price is going up and down. These are not models of investor behavior. These are not models of how a company is performing. These are not models of a balance sheet, because those are too many complex variables. So if there is enough data, if markets are liquid enough, and that's a big if, then, for example, let's take the simplest object, the S&P 500, that has statistical characteristics. And that's a good point to start. So that's sort of the departure point of, let's say, financial economics from classical economics. And some of the tools I've already mentioned are primarily the theory of probability that is more and more common in undergraduate curriculum, high school curriculum, than it has been in previous generations. Differential equations, functional analysis, these are just other branches of mathematics that contribute to this kind of area. And I've mentioned financial mathematics is also a common name for this area. So Mark had told me before to limit the number of equations I display to one, and unfortunately, a lot of what I and my colleagues do is write equations and do mathematical models. So I will stick to the prescribed number of equations and say just a little bit about some of where this theory started, which is to do with options pricing and hedging. Talk a little bit about one or two types of models where you can get a lot of insight into what's going on without doing any of the specific calculations. And then, I think what would be more interesting than going into more technical details of some of these issues is to address the the current and ongoing financial crisis. So a lot of this is related to credit derivatives, derivative securities that are based on defaults, whether it's defaults of companies or defaults of mortgage holders. And this is really the source of the troubles of the last 2.5, 3 years, this market in mortgage-backed securities, which brought down some major financial institutions and nearly brought down some others, and then had spillover effects into the larger economy. So I will say a little bit about that arena, which you could think of as having sprung from other markets that were more better understood and just sort of exploded out of control in a direction where people were dealing with things that you probably read about that they or very few people or nobody had really serious understanding of. So I will address obviously that issue. I will make some inflammatory remarks about which are obviously just my opinion as to what some of the things that contributed to this. Obviously, this is a complex story, and there's plenty of reasons for it occurring, a certain combination of things. So there's not a simple magic bullet, I don't think, that can describe exactly what went wrong. In fact, there were a lot of very dubious things going on in that period between roughly 2000 and 2007, which led to this specific crisis. And then looking forward to the future, I mean, you hear about, or the present, if you like, you hear a lot about reform, change, regulation, whether any of that is likely to be successful. Policy is not an area of my expertise, but I'd like to say a few words about that. Regret is not a word you hear on Wall Street, but I put it in that list. Or are we essentially, once this is gone, sort of back to business as usual? So I'll sort of give a few thoughts about that. So let me start with, largely I will talk about derivative securities. So these are contracts. These are securities whose value is derived from the value of another security. So the simplest thing to think about, not quite the simplest thing is futures, but the second simplest thing are call options, options written on a stock. And so the underlying object is the stock. So let's say the stock is IBM, and you have a market in contracts in which you, the holder, have the right but not the obligation to buy one share of, let's say, this IBM stock on some expiration date, capital T, in the future for some fixed strike price, capital K. So if IBM is trading at, I don't know exactly what now, but let's say 80, you might enter into a contract to buy that at, let's say, 85 1 year from now. So the K would be 85 and the T would be 1 year. And so effectively what you're doing is you're betting that it's a bet. It's nothing, that if you like when people say derivatives are complex and the actual structure of them can be, but the idea of them is they're just a bet. And if they were called bets, we know about betting at Las Vegas, we would think of them as less mysterious. So this is a bet on IBM stock exceeding $85 1 year from now, because if it's trading for $90 1 year from now, you can exercise this contract, buy it for 85, sell it for 90, and you make a profit of $5. On the other hand, if you're wrong, if your bet is not correct, and IBM is only trading at $82 a year from now, you're not going to exercise this contract, which gives you the right to buy it at 85 when you can buy it for 82 in the market, and so you don't have to exercise it. And so you have a right but not an obligation, and that's what the contract allows you to do. And of course, for that, you have to pay for that right, that it's a bet, so there's a price of it. So the principal problem, you could argue, is what is that price? I mean, I don't want to use the word fair, but what is the price that somebody selling this contract or somebody buying this contract should pay? So this line just repeats that it's betting that the stock price will exceed K. And the point is, the point is essentially, well, if I want to bet on IBM stock, why don't I just buy IBM stock? I don't have to, that's the simplest way to bet that IBM stock is going to appreciate over the next year. Why do I need this kind of a contract? And the answer is that if you are right, then your profits will be very much larger if you go with these call option contracts. But if you're wrong, then you will lose everything. Whereas, so the motivation is speculative, and this next picture hopefully describes that. It's not very well labeled. So here is just some example with some numbers. This is a profit-loss diagram. It's not very well labeled. The labels didn't come out. So this is investing in stocks versus investing in options. And you can ignore the numbers, but the strike of your call option is 105. And this labeling didn't come out. So this is where the stock price ends up at the end of the 6 months. So there are two lines here. That's all that's really important. One, this kind of flatter line is your profit loss with if you just bought the stock. So let's say you bought the stock. At 100. If the stock price ends up at 100, your profit loss is 0. And then if the stock price goes up 10% over the course of the 6 months, then your profit from the stock went up 10%. If the stock actually went down 10%, you lose 10%. The only way you can lose everything is if the stock actually goes all the way down to 0, and then you lose everything over here. So it's a way to bet on the stock price going up. The upside is not very exciting to put it, to put it in those terms. If it goes up 10%, you get 10%. But on the other hand, the downside is not so bad. If it goes down 10%, you lose 10%. But with the same money, let's say you had $1,000, you could buy 10 stocks, let's say if they were trading at 100 today, in this hypothetical example. But the real point is that the call option is much, much, much cheaper. And so with the same $1,000, you could buy 461 of these call options. And so the second diagram, this so-called leverage diagram, shows you the leverage of the call option position. So let's look at the happy part first. If you're right, if the strike of this is 105, I can't quite see it from where I am, but where this thing starts turning is hopefully at 105. And then you have 461 of these call options for your $1,000. So every dollar that it goes up above 105, you start making $461. And so that's why the slope of this line is extremely, extremely steep. The payoff on the upside is, moves up very rapidly. This is the leverage of this position. So that's the happy news. But when you're wrong, you lose your shirt. You lose everything. You lose your $1,000. And so that's the kind of the moral of everything, that these derivatives, if you're right, they can be very rewarding. And when you're wrong, they will hit you very hard. And so if you are going to invest in these things, you had better be willing to lose everything. In other words, if that $1,000 is, otherwise you would take it on a trip to Atlantic City, but you choose to do this, that's fine if you're prepared to lose the $1,000. That could very, very well happen if you're wrong on this bet. If you want to be more conservative, just buy the stock. And of course, let's hope, if we're talking about you, this is, I'm sure, your $1,000. If we're talking about Wall Street, let's hope it's not your $1,000 that they're playing with, without your knowledge. But we'll talk about that later. So that's the simplest example. I don't know if at this stage if there's any questions before I move on just how this on this particular contract. I'll be happy to to be interrupted if something's not clear. Okay, so that's fairly simple to understand. And then, that's the original type of derivative security, almost. And these are some other examples. So the flip of that, a call gives you the right to buy, a put gives you the right to sell. So these are all, don't worry about the European, this is a distinction that I won't get into right here. It's just a nomenclature. So put options are, if a call option gives you the right to buy, that means you're speculating the stock price goes up. A put option gives you the right to sell, which means you're speculating the stock price is going to go down because you lock in a contract to sell it at a higher price sometime in the future. So this you can think of as an insurance against the stock price going down. which is what it says here, and the price you can think of as an insurance premium. Credit default swaps, CDSs, these are among some of the things that caused a lot of the trouble because they're unregulated. This is a bet. This is an insurance. This is a credit default swap is just an insurance contract against, let's say, a firm defaulting or a set of mortgages going bust. You pay an insurance premium. That's the analog of the price, and that's what the pricing problem is. And if the default, or if the bad event happens, you get compensated. So credit default swaps are an example of credit derivatives, and they have complicated definitions, and or not particularly complicated. They're just like an insurance contract against default risk. Adjustable rate mortgages, that's something that came up over the past 10 years. These are things that you may not have even thought of as being derivative securities, but essentially they are, because they are things that allow you to pay a low interest rate when you start the mortgage, and then the smart mortgage salesman is going to tell you, but within 5 years' time you'll be promoted, your salary will have been doubled, then you can afford to pay a higher interest rate. And of course, not all people don't realize that the amount that they have to pay back can jump quite enormously. So ARMs, adjustable rate mortgages, these are also examples of derivative securities, derivatives on the interest rate that is prevailing for payback on loan. American options are another type of option which give the holder the right to exercise any time up until the expiration date. That's just a twist on this European, where it has to be exercised at the end. And then there's a dictionary of these things. I won't define any of these. Asian options, look-back options, barrier options, passport options, swap options, floor options, captions. There's a whole slew of the things, and this is not even getting into the credit derivatives. So these things took off, but they're just, they are just some kind of bet. If such and such happens, you get this, and if it doesn't, you don't. So that's essentially the kind of introduction to derivative securities. And of course, it's they're not all bad. I mean, these were not created with sort of malice in intent. They can be very useful because different people are willing to take different institutions, let's say, need their money at different times than others. And so if some institution is willing to invest relatively long term, then they may be able to take more risk than other institutions that need the money to be more secure. So that's why we have markets, and these are just tools that can smooth out or custom payments or risks according to your demands. I mean, mortgage securities, of course, pooling mortgages is a form of derivatives. If each of us had to go out and get somebody to give us specifically a mortgage without these being pooled, then we would be paying at a very high rate because one person would be exposed just to your mortgage risk. But a mortgage lender would much rather insure, for example, a pool of mortgages within Princeton, for example. So these are not, these insurance products or other types of derivative securities, when used in moderation, can, do perform a useful function. Even CDOs, credit collateralized debt obligations, which I'll talk about later, which were at the heart of these things. These are just reinsurance contracts and used, without wild speculation, are, if you describe it, they do perform, or they have the potential to form a useful function. So not everything I say will be, very, negative about derivatives. There are some good things, and of course they can be misused, just as any kind of gambling can, as tools of wild speculation if they're used, massively, excessively, as they were in certain cases. So there have been, before this current crisis, a number of disasters which have been linked to some form of derivative securities. Barings Bank going bankrupt 15 years ago. Orange County got in trouble in the mid-90s, early 90s. The LTCM, which was a hedge fund, long-term capital management, which had to be bailed out in 1998, and of course the current crisis. But, despite all the negatives, there's one issue which I think, will not, we cannot be naive about. Derivatives will always be around. I mean, as long as people are around. It's like saying gambling will be around, or, people will always look for creative investment vehicles to, to enact their view. If you think of derivatives as insurance, then that's a good thing for people to have access to have some sort of form of insurance. If you think of it as a tool for speculation, people will always want some form of leverage if they're willing to risk their money. So I think it's naive to say, let's get rid of derivatives. They will always be around. We can get rid of certain types of them. We can try and regulate them, and people who are in this business will try and come up with clever and disguised versions of similar things and so on. So it's I think naive to assume that somehow this market could be gotten rid of and everything will be okay. It's more a question of understanding the risks and regulating them wherever possible. So derivatives will always be around and have to be dealt with. So let me say a little bit then, just mainly in words, about the kind of models and sort of the explosion of the quantitative side of Wall Street, and to what extent it contributed or is really not developed enough given the current crisis. So this is more to do with the kind of models that culminated in a theory for option valuation by Black-Scholes, which really led to a lot of physicists, former physicists, engineers, mathematicians working on Wall Street, the so-called quants, who were in charge of some of these models. So you start with a model that quantifies randomness, for example, uncertainty about stock prices in the future, and a starting point is an object called Brownian motion, which is a mathematical thing. If you can think of it as a function that just behaves extremely crazily and has reasonably tractable mathematical properties, and if you plot it, if you look at a picture of it, it looks like it has the craziness of a tick-by-tick stock price. So this was created by a PhD student in 1900 whose name is Bachelier, and he was, ironically, given how this story ends up, his actual objective was to model the Paris Stock Exchange, the Paris stock market. But his work it didn't take off, it was ignored, he sort of disappeared into obscurity. And really, these stochastic models were much more used in physics, which is perhaps why a lot of physicists find the career change to finance quite attractive. So this Brownian motion object was rediscovered by Einstein in 1905, and this was, as you perhaps know, this was his great year when he published all of these papers, any one of which could have won the Nobel Prize in Physics, and this is one of them. He rediscovered it. He didn't know the work of Bachelier. And then for the next 60 years or so, it's a basis of electrons. It's not stock prices, it's electrons. It's particles in physics that these things are used for. The name Brownian motion refers to the person who discovered that grain suspended in a fluid moves about erratically, and that's why it's given this name. That was a scientist named Brown. And then there were mathematical developments. These are purely abstract. These are people who were not interested particularly in physics, and certainly not in finance. Wiener, Levy, and Ito is a Japanese mathematician who had one of the kind of fundamental scientific breakthroughs, and they were working on this. This was kind of abstract mathematical development during this period. Ito was responsible for something which is sort of fundamental in the analysis of these models, which is called stochastic calculus. He developed it in the 40s. Nobody cared. Even Ito didn't care. He wrote a book 15 or 20 years later which doesn't even discuss stochastic calculus. So this thing lay in obscurity for a long period of time during the 20th century. And then it was rediscovered by an economist, Samuelson. Samuelson is a famous economist at MIT, died just around Christmas time last year in his 90s. And many of you maybe took an economics course where his textbook which I think originally was from the 40s, and is still used in sort of freshman economics classes. So he was a promoter for these kind of stochastic models to be used for modeling stock prices. So he had to sort of come back to where Bachelier had started it, and from the mid-60s on, the economists primarily started looking at these models because they seemed to give some nice answers to some questions that they had not been able to deal with. So the big the big thing, if you like, for this area was something called the Black-Scholes formula, which is, or the Black-Scholes option pricing theory, which was published in 1973. And this is an explicit pricing formula for those kind of options that I was talking about before. So these options, call options, put options, they had been sort of discussed as something that people might want to trade, but people had no idea what the, how to come up with a price for them, because there were certain things that they seemed to depend on too many variables, et cetera, and there was a, there was a very much a, there was very much a desire to have a market in this thing, but nobody knew how to put even sort of a ballpark value on them. So when this Black-Scholes theory was published in 1973, a couple of things happened by coincidence. So it's a formula, but it's a complicated formula. It needs to evaluate cumulative normal distribution functions, these things that you may have previously learned in statistics classes by looking up in tables. At the same time, just by pure coincidence in 73, the CBOE, the Chicago Board of Options Exchange, opened. And around the same time, the Texas Instruments handheld computer is probably the size of an iPad by today's standards, but it was described as handheld, was discovered. And so traders in this new CBOE were able to walk around with this device programmed to, programmed with this Black-Scholes formula, which was a reasonably good ballpark. It's not perfect by any means, but a reasonably good ballpark enabler of what the value of an option should be, and this market took off. So initially there were call options on 16 stocks in the mid-70s, and then by the year 2000, this market, the Black-Scholes model itself in its original form is not, even Black and Scholes knew this when they published it, is not a good, or is not a particularly good, it's good in the right area, but it's not perfect by any means, and there are certain flaws with it. So a lot of different models were developed, but the market in calls and puts, which had some quantitative analysis behind it, by let's say 2000, these objects were traded on over 1,200 stocks, relatively liquid stocks. And then two of the originators, there's another economist, Merton, who his name is not in it, but he's instrumental in this. He and Scholes, Black having died, were awarded the Nobel Prize in Economics in '97. And then next year, one of those derivatives crises occurred with this hedge fund LTCM, in which Merton and Scholes were involved. So that was a lot of rain, let's put it that way, on their parade. And we'll talk about what the gap is between options and then the more complicated things that seem to cause these crises. So that's the historical idea, and maybe I'll say a word or two about what the idea is. So the idea is to try and find the value of something which is a derivative, in other words, whose value is derived from something else, by finding some trading strategy in things you know the price of, which replicates the payoff of the thing you're trying to price. So in these models, you can replicate or synthesize an option by trading in the stock and putting some money in the bank or borrowing some money in the bank. That's the basic idea. So, at one level, it's complicated. It's complicated, and it gets more complicated as the models become more sophisticated. But the idea is simple, that you try and find the price of something that you don't know as the price in terms of the prices of things that you do know. It's complicated to do that, but that's the essential idea. And when the models are simple, when we're talking about call options on stocks, when the markets are relatively simple, that's an idea that has some tractability. So the basic argument, I should have said, is no arbitrage. If you have two things that are priced the same, then if the market is moving relatively efficiently, then they must be priced the same. And if they were not priced the same, then everybody would buy the one that's cheaper and sell the one that's more expensive, and very quickly the market would equilibrate so they are the same. So this is a reasonable principle on which to value things whose payoffs are derived from something else, that they should be priced to they should be priced such that there is no arbitrage opportunity. And this is the concept of mark to market. And it's very simple. And when finance was taking off, classical economists didn't like this because there's no reason behind the price. It's when you explain the idea, it's very simple. Just some of the technicalities are involved. And so this quote, I didn't know until recently, but this quote I think is at least attributed to Larry Summers, who was an economist before he's now in the Council of Economic Advisors. He was a Treasury Secretary, but he's a classical economist. And some of those people derived it or derided it, perhaps correctly, as it's not classical economics in the sense it's not providing intuition for why these things are valued. It's just telling you what their values are. So his derisory term is catch-up economics. That the intellectual content of this is how do you find the price of 2 bottles of ketchup? You find the price of 1 bottle of ketchup and you multiply by 2. And of course, that is sort of the idea as I've tried to describe it to you, because you're trying to find, it's just, it's not as simple as multiplying by 2. And the truth is also, it doesn't, in modern markets, it's not as simple as that, because there are things that are not traded like volatility, and it doesn't quite work like that anymore. So that's some sort of history. And then the mystique is also that if you can do such a thing, you can hedge, because you have 2 things that are priced the same. And if you want to hedge, which means to minimize or eliminate the risk of one, you could enact the opposite of the thing, which is its duplicate, and that would hedge the risk. So in other words, if you have some option position, then you could hedge the risk by selling the appropriate amount of stock and putting some money in the bank, and the 2 positions would cancel each other out, and that's a hedge. And in simple models and simple markets, you can do that perfectly. In more sophisticated ones, you can do it quite well. And where you really don't understand what's going on, then this really is a mystique. And one of my colleagues tells the story, I'm not sure if this is true, that hedging was pioneered by Napoleon's mother, that during the war between France and England, she bought British war bonds, and so she was hedged. Whichever way the result went, she was. But I have no idea if that's true or not, but I'll tell you that. So actually, because this is the time, I'm going to skip all the math and get to the kind of the current situation. So credit risk is, as I've already said, I think defaultable instruments. They pay one side of the contract if a default event such as a non-repayment of a loan or a mortgage occurs, and in return for that insurance, somebody pays a premium. So these are the 2 sides of any type of a defaultable instrument. And this is a market that was fueled by a flat stock market in the period after the dot-com bubble collapsed. So this number says that the market in credit-linked derivative products grew more than 7-fold in recent years. So from 631 billion in the first half of 2001 to almost 12 trillion in the first half of 2005. Of course, you know how this story ends, but that was the growth over that period. And there is a sort of a feedback effect that there was a demand for things to bet on. The stock market was relatively flat. Interest rates were low. They're still low. A lot of money was coming in from sovereign wealth funds from abroad, and they wanted things to bet on, which sounds terrible, but they were looking for things that would pay a higher yield, and there were a lot of people in the business of trying to convince them that certain things were not risky, but they still paid you a lot of money, and a lot of people were willing to believe that. So this is the arena of credit risk, and then the products, which you will have heard a lot about. So the notorious thing is the CDOs, the collateralized debt obligations. So these depend on the number of defaults over a fixed period of time of a huge number. It could be, for example, up to 300 firms, or if we're talking about mortgages, this is in the tens of thousands of individual mortgages. So this is a bet on a pool of risky events. And then these things are tranched. So I mean, tranching is just it's just a picture which means that I have a pool of the loans and I tranche it. Tranching just means slicing up into various things. And the question is when the defaults start coming, which ones, you sell various pieces off to various people, which ones are hit first. And so, let's say the top tranche, this is very risky, and the senior tranche, which gets hit last with the losses, this is, quote unquote, this is safe. And that's the idea. It's nothing, it's just a pool of mortgages, and different people own different parts of the pool, and there's an ordering as to who takes the hits first. So this is all that a CDO is, and it's not, the market has exploded, but in reinsurance markets, these kind of tranches and things have been around for a century or more. So it's not a brand new idea that just came up in the last 20 years. But on the other hand, it has been used as a facade to cover over a lot of things. So CDOs are these things. CDO squareds are CDOs written on other CDOs, and these are, if you like, these are even more complicated. You take a bunch of these CDOs and you take, let's say, the middle tranche, you put those together in a pool, and then you create another CDO out of that. That's the CDO squared. And what I'm talking about here primarily is corporate debt of companies, which I want to make a distinction with when we get to mortgage. In the corporate market, they were smart, and they realized these CDOs squareds are much too complicated. And so there was a brief activity in them, but they were dropped in 2005. There were quants and so on who told them that these are too complicated, you can't trade these things. And that's one of the things that was missing in the mortgage market was quants telling them that. And so here I'm referring to a class of models in this credit derivatives business called copular models, which are in some sense taking the limit of these kind of quantitative models to an extreme and sort of assuming that these things can be hedged and replicated when in actual fact they're not. So I will say that these models, which were used a lot in the industry, they were derided in academia. There's I can find hundreds of academic papers whose first sentence is that the copular model is ridiculous. But these were used a lot in this business in the 2000s because traders liked them. They were fast, they were simple, and they were wrong. But they were fast and simple, and they gave you a number, and they made you feel good about the trades that you were doing. So there was a cultural problem, and that perhaps still persists in Wall Street, that sometimes the quantitative side is used to obscure, is sort of like a fig leaf for taking insanely risky trades, and some of these models that they used have been guilty of that. So in terms of the history, I always want to quote this Wall Street Journal article from 2005, because people often say, nobody saw this coming. What went on in the last 2 years? How could this happen? Didn't anybody say this was going to happen, etc.? Well, they did. It was a front-page article in the Wall Street Journal, and this is September the 12th, 2005. The title of the article is "How a Formula Ignited a Market That Burned Investors," and I would just like to read a little bit about it, because if you think this was written in 2005, it's quite prescient. So there was a crisis in May of 2005, much smaller than what we had in 2008, but General Motors and Ford were downgraded by the credit ratings agencies, and suddenly, there was credit spreads of other companies went up, and there was a great deal of turbulence for a short period of time in these credit markets. And this is an article written a few months later. So when a credit agency downgraded General Motors' debt in May of 2005, the automaker's securities sank. But it wasn't just holders of the GM shares and bonds who felt the pain. And then it gets a bit poetic, like the proverbial flap of a butterfly's wings rippling into a tornado, GM's woes caused hedge funds around the world to lose hundreds of millions of dollars in other investments on behalf of wealthy individuals, institutions like university endowments and wealthy pension, and via pension funds, regular folk. And then this is the story of the person who was a Wall Street person who invented copular models and the fig leaf, so to speak. So all of this traces back, in a sense, to a day 8 years ago when a Chinese-born New York banker got to musing about love and death, specifically how people tend to die soon after their spouses do. Therein lies a tale of how a statistician, unknown outside a small coterie of finance theorists, helped change the world of investing. The banker David Lee came up with a computerized financial model to weigh the likelihood that a given set of corporations would default on their bond debt in quick succession. The model fueled explosive growth in a market for what are known as credit derivatives, investment vehicles that are based on corporate bonds and give their owners protection against a default. This is a market that barely existed in the mid-90s. Now it is both so gigantic, measured in the trillions of dollars, and so murky that it has drawn expressions of concern from several market watchers. So this is back in 2005. The Federal Reserve Bank of New York has asked 14 big banks to meet with it this week about practices in the surging market. So a lot of people knew that this was a ticking time bomb, including the Federal Reserve of New York. The model Mr. Lee devised helped estimate what return investors in certain credit derivative markets should demand, how much they should have at risk, and what strategies they should employ to minimize the risk. Big investors started using the model to make trades that entailed giant bets with little or none of their money tied up. Now hundreds of billions of dollars ride on the variations of the model every day. The problem, the scale's calibration isn't foolproof. The most dangerous part, Mr. Lee himself says of the model, is when people believe everything coming out of it. Investors who put too much trust in it or don't understand all of its subtleties may think they've eliminated the risks when they haven't. So this is 2005, and then let me read one more section of this. So the story of Mr. Lee and the model illustrates both the promise and peril of today's increasingly sophisticated investment world. That world extends far beyond its visible tip of stock and bonds and their reactions to earnings or economic news. In the largely invisible realm of derivatives, investment contracts structured so their value depends on the behavior of some other thing or event, credit derivatives play a significant and growing role. Endless trading in them makes markets more efficient and eases the flow of money into companies that they can use to grow, create jobs, and perhaps spread prosperity. But investors who use credit derivatives without fully appreciating the risks can cause much trouble for themselves and potentially also for others by triggering a cascade of losses. The GM episode proved relatively minor, but some experts say it could have been worse. So all this information was out there. This article is not talking about mortgages. So that's the only difference between, this is talking about the corporate debt market, and that's not where the problem occurred, but the problem as it did occur in, is almost an analog of what's said here in the mortgage market. So I don't know how much time I should, no, 10 minutes. Okay, so let me go into a little bit about that. So a lot of this you will have read. I mean, CDO, somebody did account that in the New York Times it was never used before 2000, or maybe it was used 3 or 4 times before 2007, and now it's used in the New York Times, practically every week. So I make a distinction about, having read that article and talked about, these kind of models in corporate credit. It was even worse in mortgage-backed securities because there wasn't even really much of a model. So the crisis erupted from mortgage-backed securities, MBS, which are pools of mortgages. So inside that box, there's tens of thousands of mortgages from different places. CDOs written on mortgage-backed securities are in fact CDO squared. So that's one thing that was a shock to me 2 or 3 years ago. CDO squared in corporate credit, which is an area where, at least there is some mathematical modeling, not much. They had realized, that you cannot, CDO squared is just much too complicated. That's a ridiculous object for anybody to trade. It's just too complicated. But every day in the much bigger mortgage-backed securities market, people were trading CDOs on mortgage-backed securities, but mortgage-backed securities are themselves CDOs. So this is really, a CDO squared itself. And their senior tranches were given AAA rating. So I expect probably most of you are familiar with this story, but this so-called alchemy was you have a bunch of mortgage-backed securities. You have tons of them, and so these are the mortgage-backed securities. So these could be mortgages in Oregon. These could be mortgages in Delaware. These could be mortgages in California, and these are tranched. And then the senior tranche, these are safe because they're the last ones. Only if all of these mortgages have defaulted will these people have to be liable for any of the mortgage defaults. So these things are rated AAA. So the safe one at the bottom, which is protected by all of these are rated AAA, and these are popular. These trade very well. And then people noticed who are trading this kind of thing that, well, the next one's up, they're rated triple B. They're not so popular. So how about if we take all these triple Bs and put them into another pool? This is the CDO squared, and then tranche that. And then, and then guess what? You put all these triple Bs, and there is a senior tranche of all the triple Bs, and miraculously that becomes a AAA. So because it's the best of something, it's the best of all that. You could call it. I know this is an adult school, and I shouldn't use adult language because of that. But I like to say that is then you can put your own letter in for the star. That's exactly what went on. That the senior tranche of the triple Bs became suddenly miraculously triple As, and a lot of people, either were duped by that. So what I'm trying to say here is that the AAA has many, has a lot to answer for. So the first thing is, of course, it disguises the fact that it's made up of triple Bs. The second thing it does, it makes you think that it's a bond. It's a U.S. government bond. It's not a bond. It's a highly complicated derivative security, which depends on mortgages all over the country. It's a 400-page contract. So it's not a U.S. government bond. So the AAA disguised a lot of that, and whether people were duped or were willingly duped to get over their own regulations, it sold very well. The ratings agencies, of course, we're talking now about the housing market. Their worst case scenario was that house prices would go up by 0.0%. That was the worst case scenario that could possibly happen. So giving this a AAA, you could produce some numbers which justified that. And then there was this issue of independence that I said, that these are mortgages in Oregon, these are mortgages in Delaware, and these are mortgages in Texas. There's no way they're all going to default. That's just, that's not going to happen. It's never happened. There have been housing crises in the U.S. in various places, but the average house prices in the U.S. have never gone down over the last 60 years. And that's, of course, true. These are independent, unless the whole economy goes down, because they're all linked by the U.S. economy. So the argument of independence, may sound good, but of course there is one scenario in which everything goes wrong, and that's when everything goes wrong, which is of course what happened. And so they all started defaulting, and then even these so-called AAA seniors, these AAA seniors went down. And then, in defense of not in defense, but I was not aware personally, having worked in this kind of quantitative finance for over 10 years, that this mortgage-backed securities thing was so big. Simply because you would go to conferences, read academic papers. Nobody was talking about mortgage-backed securities. People were talking about CDOs on corporate debt, which is something that people had studied. But the mortgage-backed security book in most banks was 10 times the size of the corporate debt book, but there was hardly anybody doing analytics on them. In other words, there were no PhDs working there. There was no, as there were in sort of equity derivatives desks or interest rate derivatives desks. And the reason is, again, this AAA. If they're AAA, you don't need any math. They're AAA. Anybody can understand this kind of thing. So that's one of the reasons that's one reason that a lot of this was sort of a shock to many of us, because, and it's not that we could have done anything about it except to say that these products were crazy and that you can't write any model for this kind of thing. So let me try and wrap up in a couple of slides. So just to say a little bit about, this is a complex story, and it's not easy to, it's not easy to say, what was a mistake, what was a willing mistake, what was negligence, what was this, what was that, and this is, of course, something, there are hearings going on right now, which are very interesting that people are talking about. So some things, of course, do seem, to contribute to a culture where these kind of risks are taken, excessive risks, and that is the bonus, the huge bonuses. Most people live in fear of losing their job unless you happen to have made $10 million that previous year, and then job security is not so important to you, and nor is even the health of your firm. You're not particularly vested in the institution that you work for if you make that kind of money. So bonuses is an easy thing to go after, but it's, it does seem to contribute quite simply. I'm talking about traders here taking insane amount of risks. Quants, people who were doing the models, they were hired, and their hiring and firing was decided by traders. And traders wanted to trade. Traders didn't want to be told their trades were too risky. They didn't want to be told the party was over. So anybody who sort of came with that message, they didn't do very well at bonus time if they still had their job. That's wrong. That's, it's like the person managing the risk, reporting to the person who wants to take the risk because he gets compensated on that. And so, quants, either they did not speak up or they were not heard. I mean, if you were the guy in a certain bank 5 years ago saying the party's over, they would say, well, goodbye. We're having a very good time. So there was not much they did, and there was not much that they could have done. Management, they may not have known the details. Sure, they did not read these 400-page contracts. But you can take a cynical view and say that they were buffered by the knowledge that they were too big to fail. And actually here the mortgage arena, actually provides them some cushioning. If these were things written on a bunch of U.S. stocks, and those stocks started going down, if these were call options on stocks and they started losing, expiring because the stock went down, the U.S. government is not going to step in and make the stock prices of those companies go up. But when you're talking about mortgages, you're talking about, in your head, you're talking about homeless people. And, I believe that there were some people, whether it's in the back of their mind or the forefront of their mind, they knew that if there was a mortgage crisis, the government would step in, because we're talking about homeless people. You can have stocks go down, but you can't have homeless people. But the irony is, where even they were too clever for themselves, is that there wasn't a huge homeless problem, because these mortgages were so subprime that it was actually better. The people were better off defaulting. Nobody went homeless. You just put the key in the mailbox, and then you either buy the same place for a fraction of the price or you rent somewhere. These were not people who were thrown out onto the streets. And so the mortgages defaulted. But there was nobody for the government, for the government, what they had to take care of, or what they did take care of, are the banks, not the people who had the mortgages. So there wasn't this huge problem, which you would normally expect. And the reason is because the mortgages were subprime. These were people who were like, well, I never really expected to live in a place like this. Now I can't live in a place like this anymore. That's fine. I'll go back to where I was. These were not, these were people living beyond their means. And so, in some sense, the cushion that I believe a lot of the institutions had in the back of their mind really wasn't a cushion. And they got into bigger trouble than they thought even they could. And rating agencies, they were paid by the people they were paid to rate, and the more deals they approved, the more fees they would recover. So, what about now? I mean, 1 year, 2 or 3 years later, the bonus culture still persists. We know that. Once one firm does it, the argument is everyone has to do it. Otherwise, their better traders will go over there. Quants, this has got better. Quants report now to management, and they assess the risk. I mean, they assess the risk of a trade, and they report to management, and certain people are charged with signing off the trades. They do not report to the traders, so that is a good development in many of the banks. And in fact, if you look at some of the banks who weathered the storm, they already had that system before, compared to some of the ones who did worse. We all know the too big to fail firms got bigger, so that's not a particularly good development, because of the mergers and so on. So that's not a particularly inspiring development. And then regulations are being discussed. There are bills in Congress putting CDS contracts on exchanges, so they can't be so people have a sense of who owes who what, creating an exchange for that. That seems likely to happen. There are certain new, there's reform at the Fed, but there's, some people have talked about National Institute of Finance, which is kind of like the National Institute of Health, to monitor if there's going to be an epidemic or a huge outbreak of the systemic risk, and really to collect data so that, warning signals can be detected. So National Institute of Finance is something, it's part of this bill. I don't know if it's going to happen, but that's the kind of thing that's up there. And then, structured products have dried up, but they will return in some disguise, because people will, as we'll discuss that already. And the only thing that I can hope is that I mean, of course, I'm biased in favor of people with quantitative training who are doing this kind of work, that they will be the people who oversee the design and of these kind of derivative securities. In other words, you know, they should not be designed on the back of an envelope, you know, where you can say, let's put this in and let's put that in, and if this happens, that happens. There you go. They should be designed by people who can see, A, if these are too complex to put a number to, and, you know, B, are these something that for the person being who's going to buy it, they can understand what the risk of it is. So hopefully, you know, one thing I hope will come out of this crisis in terms of the subject I'm in is that this will see this become a more mature industry. I mean, for example, I mean the analogy what people make is to plane crashes and bridges falling and so on, which calls for a demand for more understanding from a scientific perspective of these problems, and I hope that's going to happen here. So let me stop there.
I could go back to the beginning where you were talking about these Muslims basically being a form of gambling, and also they've only really developed over the last 20 to 30 years. You can say they will still be around, but we could have a perfectly functioning economy 30 years ago, just like we didn't have gambling in Atlantic City 30 years ago.
Right.
Both possibilities are
Yeah, I mean, I think it's you know, once something exists and there is a demand for it, you know.
It seems like it's saying we should be embarrassed to believe that gambling is an essential part of the economy. It's not.
Yeah, no, I mean.
Furthermore, it doesn't create any wealth. I mean, in Atlantic City, it just takes money from some unfortunate people and gives it to others.
Yeah, yeah.
It doesn't create any wealth.
No, I mean you know, that's a fair point, and I'm agnostic on that. You know, my rather pedestrian view is that some people are going to do it, and then when some people do it, other people are going to do it. It's not something that you can stop people doing. This is a free economy. You could regulate it, yes. So that's so that I believe in, but I don't think we can deny its existence. You know, we can only try and. We can be embarrassed. We can be embarrassed by bonuses. You know, I know people who are embarrassed at their kids' bonuses. I mean, it's yeah. No, there's plenty of room for embarrassment. I totally agree with you. Yeah. Well, you know, tax is a word that is it's probably used more in Princeton than in Washington. I mean, yeah. Again, these are reasonable. You know, these are reasonable suggestions. You know, to put a tax on these trades and you know, disincentivize from that point of view. The only thing is that, you know, the people who want to do this, and again, I don't want to make them sound, you know, duplicitous, but I mean that's the business they're in. That's, you know, that they have clients' money and they're charged with you know, getting returns on that money, but they will find loopholes. There will be a new product. I mean, you know, this, you know, going back to the blaming and stuff, the repeal of the Glass-Steagall Act in 1999, which took a lot of these things, you know, declassified. You know, they're not classified as insurance products, so they're not subject to the same regulatory capital requirements. You know, people are always creating loopholes. But no, I agree. There should be, you know, knowledge learned from this crisis that. You know, but part of the thing is that the sharper, younger, creative people are going on one side, and you know, not to you know, speak ill of the people who work on the regulatory side. They're not the people, you know, they're playing catch up. I mean, it's the regulatory side is always playing catch up, and that's been a problem. The back. Mm-hmm. No, yeah, no, yeah. So Yeah, I mean, they got too complicated for the people who were. Yeah, yeah, no, I agree with that. I mean, a priori, they can. I mean, they're insurance contracts. Everyone believes in insurance, so uh, they're not all bad. Used excessively and misunderstood, they're terrible. Yeah. Well, I mean, a lot of people were, a lot of the investment banks that got into trouble, they so believed that these things couldn't happen, they kept a lot of them on their books. So Merrill Lynch, I believe, kept a lot on their books. Citigroup kept a lot on their books. So there's also a willing duplicity that a lot of people believe the housing market will not go down. But the thing is, if you take this risk, the Z's or this one, it pays you a high yield. So if you're willing to, insure this, then you will be getting, interest rates are basically zero. You will be getting, 1,600. I mean, you'll be getting 16% interest or something on this thing. And a lot of the time, you don't even have to put up the money. You just have to say, yeah, okay, I'll take that. A lot of these were unfunded. You didn't even have to have the money ready. You would just get the return. So hedge funds would play that game. These are, where can you get 16%? Well, here, and if you really believe, I mean, derivatives are bets, so that means you believe the position you're taking. So if you really believe the housing market is not going to go down that far, there will be people who are taking that, and a lot of time the banks themselves really believed it.
Thanks for your talk. There seems to be an impression that I'm getting from the audience that people think that these types of instruments go back 20 or 30 years. I think they go back thousands of years.
Yeah, I mean,
Back to Phoenician times and the Greeks.
you can probably, I don't know if, certain of these specific things, as we now term them, but I'm sure you could find examples where two people entered into a bet, and if this happened, I would pay you this, and if that happened, I would pay you that. So, yeah, so, I mean, again, bet. If you,
That's very wrong. So I also get the sense from some of the comments that these instruments have been fairly demonized tonight. So I'd like to ask you, in your opinion, what would happen, what would be the effect on the economy if these derivatives and options disappeared?
I mean, so realistically speaking, these kind of things, it's like gambling. It's like, opportunities to invest. People are in the business of creating opportunities to invest, other than stocks and bonds. So realistically, I don't think that's going to happen. But if they were, what would be the effect? People who have a lot of money will have to put it somewhere, and I don't know. I mean, if you're saying that they can only invest in stocks, bonds, foreign exchange, then one of those will surge. I mean, it's hard to predict what it would go into.
Well, then it seems like your theory or thesis or premise is that the majority or all the transactions that occur in these instruments are simply speculative. What about the vast majority that are fundamental in the structure of finance and business?
Sure.
Real businesses engage in genuine strategies that minimize risk or enable financing.
Absolutely, yeah.
Securitization of products that enable them to do actual business.
Yeah, I mean, I absolutely, hope I presented it fairly, that they're not all bad, but what happened over the last 5 years, they were taken to the extreme. So they perform a genuine function. I mean, airlines hedge their foreign currency exposure with some types of Asian options. People reinsure insurance contracts. So these are all, legitimate forms of derivatives. Where it got crazy was the equivalent of, people buying insurance on other people's houses, I mean, or other people's cars. So, Mark might insure his car because he doesn't want to wreck it. But if I start insuring his car as well because I want to bet whether he's going to wreck it or not, that seems a little excessive because I just have things I want to bet on. And so that's where it sort of spiraled out of control. Now, where you draw the line between what's genuine use of derivative and what's speculative, I mean, that's in the eye of the beholder, and that's, I mean, no regulatory body could have the power that they'll be able to say, that's okay, but there's just too much going on that could not possibly happen. So yeah, no, I mean, it's a delicate issue that, they do perform a crucial function to businesses. They keep our mortgage payments lower than they otherwise would be. They keep our insurance payments lower than they otherwise would be if we had to find an individual insurer for each of ours. So they certainly play a role. I mean, we would notice. I mean, maybe that's the answer to your question. We would notice if they all disappeared. All our any kind of insurance premiums would go up. But then, perhaps the economy wouldn't be brought to the edge of collapse every 10 years. I don't know. I mean, it's hard to draw the line between saying, what is cause and effect. But I generally believe there's no way that they are going to disappear in any form.
We've gone from corporate debt, mortgages, there's a speculation that we might go to student loans. The government took care of that. We speculate now that we might go to muni debt in terms of this. What's your best guess as to what area we're going to be looking at and hearing about over this time?
There was a rumor they were looking at life insurance premiums, which is something that they did in the 80s during, they lost a lot of money on that in the 80s. So old ideas never die, and they come back. I mean, all I can say is that, there are people who are paid to do this, so we shouldn't deny. And I'm not out to vilify or anything. I mean, these are there. I'm just hoping that these things are done in an informed and technical way. That's all. So yeah, wherever there is risk, people want to, trade that risk, and that can be a good thing because people who have too much risk can diversify it away, but it can lead to undue speculation. So if they do lower life insurance premiums, that's a good thing. But on the other hand, if a collapse in that market triggers a bigger collapse in the larger economy, that's a bad thing. But it's hard. It's hard to find the line. It's hard for anybody to find that.
A real bad flu epidemic would take care of the life insurance.
Yeah, it would. Yeah. So that's. I mean, I think that's where it went wrong in the 80s with the AIDS epidemic or something. Yeah, they lost a lot of money. So yeah, there's a grim. I mean, nothing's too grim. Yeah.
Let's thank. See you all next semester.